Retire early or FIRE is a movement that can be very attractive to younger investors. It is an approach to investing that front loads all the hard work for an easy second half. But does FIRE do well in a recession? Can a recession come along and pour a whole lot of douse on those financial flames? Today, we will find out, and we will begin right now. The idea of FIRE has been around for a while, though recently in the 2010s, millennials have been very interested in adopting a FIRE strategy towards investing. Of course, as some of the Zoomers come of age, they too are looking at it. Is FIRE truly the easiest path to riches? It may be, and at the same time, it may also be the hardest. FIRE requires a strong commitment to investing, and for younger people, that can be a tough pill to swallow. Before we start pinching those nickels and dimes, hit me up in the comments below and let me know if you have thought about adopting a FIRE strategy. Also, if you are new to the channel or one of those folks who watches all the time but hasn't subscribed yet, yes, I am talking to you, John, please click on that subscribe button. It's free and it helps me bring more content to you. Also, be sure to stick around to the end as we have a bonus topic just for you. What exactly is FIRE? In a nutshell, the financially independent retire early strategy is one where you utilize financial minimalism to invest every possible dollar to get that snowball of returns happening much faster. These returns grow fast and propel your overall investments towards the option of early retirement if you so choose. The initial focus of FIRE is to increase your income as much as possible, which includes adding as many income streams as you can. Often the devoted FIRE acolyte will have a main job with perhaps a couple of additional part-time jobs. They will also have a side hustle or two. Holy banana bread, we are talking about a very busy investor. Luckily, when you are younger, it is much easier to burn the candle at both ends. Also, at the same time, $100 earned when you are 20 is worth $1,744 when you are 50, provided you can invest it with a 10% average return. At 30, $100 is only worth $259 with that same return. Therefore, all the hard work is front-loaded to take advantage of a maximum snowball effect. It takes time to compound your returns. For this video, I will use a 10% return just to make the math easier. It may be lower as the average S&P 500 return over the last 20 years was 7.45%. However, a good investor can certainly outperform the S&P, and a 10% return is not unreasonable. If we look at it, a steady investment where a 20-year-old invests $100 per month with a 10% return when they hit 50, in that case, they would have $208,000. That's not too bad, but it's certainly not retire early money. If they were able to invest $200 per month, they would have, well, $416,000 in that case. Keep in mind, this is with a steady investment. With FIRE, we are trying to front load that. If we invest $750 every month for the first 10 years, then $500 for the next 10 years, and then finally $200 for the remaining 10 years, in that case, we would have $1.3 million. And I will tell you, if you can live off of $50,000 a year, $1.3 million would be absolutely a perfect target for you. If we reverse that and did $200 for the first 10 years, and then $500 for the next 10 years, and then of course topped it off with $750 for the last 10 years, we would only have $681,000. That really demonstrates why front loading is so important when it comes to FIRE. I did mention that a key part of the strategy is financial minimalism, especially in the first half of this financial journey. Of course, when I think of financial minimalism, I can't help but think of Graham Stephan. Graham is an American YouTuber who tends to demonstrate minimalism to an almost over-exaggerated level. Honestly though, if you are looking to succeed at FIRE, then you need to be that committed. On the bright side, if you can really ramp up your income streams, you have more room to loosen the financial minimalism a wee bit. At the time of recording, we are more than likely headed into a recession. Will a recession stamp out the flames of a good FIRE strategy? The answer to that is no, But it does need some explanation. You have to absolutely zoom out. And if your goal is to start FIRE at 20 and retire at 50, then that 10% return is an average return over that time. That means you may have a 20% return one year, maybe a 15% return another, and when you get to that recession, you may have negative 10% return for a year or two. However, over the big picture, it averages out to our example target of 10%. The biggest recession play for FIRE is to not sell, but rather buy those high conviction stocks when the market is deep in the red. In a way, buying deeply discounted good stocks in a recession can be another chance to get some of the bigger returns on the journey. A recession, if you are prepared for it, can be a great opportunity to move you towards your FIRE goals. It is like an investor's holiday. A question I do hear from time to time is, I am older than 20, can I still start FIRE? The older you are when you start means the longer it is going to take you to reach those goals. And eventually, you may start at old enough that you are just able to retire at the normal retirement age. It is still FIRE in a way, as a lot of people are retiring much older, and there is a surprising number of people in their 70s who are still working full-time. It really doesn't matter how old you are. You can still embrace the FIRE spirit, and the worst case is that you never retire early, but you retire in a much better position than you would have if you never tried. Some younger people may rub it in that you are too old to start FIRE, but you know what? Your finances are your business, and the FIRE spirit belongs to anyone who wants to embrace it. That is a great place to end and move into our bonus topic. So what happens after FIRE? Well, we get to spend some of that money. Because we don't know how long we are going to live for, we can't just have a free-for-all with our investments, as that is a quick way to undo all the work that got us here. So, we need to look at a way to utilize our investments in a sustainable way. If we have a 10% average return on those investments, then we cannot spend more than that 10%, as that would then begin to whittle away at our nest egg. So, that is where the 4% rule comes in. With FIRE, our goal in retiring is to have amassed enough investments that we can live off 4% per year. So if you can live off a $50,000 per year in retirement, you need an investment portfolio of $1.25 million. Or maybe that 1.3 that we mentioned in our example earlier. The beautiful thing is, if it is growing bigger than you are using, then that 50,000 the first year grows into 52,800 the next year, and so on. It will keep getting bigger, and it is a rate that should pace you with the cost of living. Yes, the pandemic has boosted that amount for a short term. Within a few years, it should even out, and that 4% rule will serve you well in the long term. Obviously, that 4% rule is just a guideline. If you've amassed a very sizable investment, perhaps you can afford to look at a 5 or a 6%. But I still like the 4% because it does keep everything growing. So even if you don't spend all of your nest egg during your lifetime, it's a little something that you can pass on to the next generation, which is always a nice thing. Maybe you can settle an argument for me. I think you will like my video on Canadian Western Bank, or you can try the video YouTube thinks you'll like. Your click will decide who's right, and I'll see you in the next video.